Thanks for joining us again today in studio as we actually do an annual policy review. And believe it or not, we've got one of our very own, Robert Lee, in the building, and we're going to take a look at actually his very first policy. Back when it started, we'll compare, we'll look at where it is now, and we'll kind of walk you through what's happened in the last 2 years. That sound good to you?
Sound good to me, man. Let's do it.
Well, tell everybody a little bit about yourself, who you are, and why you're in studio with us here today.
Yeah, man. So like you said, my name is Robert Lee, and I've been a part of the Cash Compound, and it's been good working with the Banking Bros. We help individuals as infinite banking practitioners. So we help people become their own bank. And of course, we practice this infinite banking concept inside of our own personal lives. And that's why we're looking at my policy now, because we're coming up on year 2 since I've had my policy, my first policy that is, and we're looking at the differences and seeing, how does doing banking with the policy, like what we tell people, and expanding on just more than just having a policy, expanding on our lifestyles as far as like making purchases, paying ourselves back, taking more control of our wealth. What does that look like, and how does it impact our lives on paper?
I love it.
That's what we're doing, man.
I love it. How often, Robert, do you get the question asked by people out there watching on the YouTubes, on the socials, people that you talk to on the phone, do you actually practice this?
Yeah, I think that from the conversation, they know we definitely have a firsthand experience. Every now and then, people want to know your own personal experience and story with it, and that's what I do. So I let them know, hey, man, when I got started, I was kind of like you. I didn't know a lot. I had similar questions. I thought it was unbelievable and all this other stuff too. Now that I'm doing it, I expanded on that to now go on to hopefully by the end of this year, we can have a 5th policy inside of our household. So
I love it.
That's what we're moving on to now, man. And the more you learn about it, the more you know. And just today, you taught me something a little bit newer to me than what I thought about it. So I think that you can never stop learning in life, and definitely infinite banking is infinite. So you need to keep learning, continue your education, subscribe, like the video, leave a comment so we can help you guys out.
I love it. I love it. So officially, your very first policy, I know you've got 4 now, working on the 5th one, but your very first policy started way back in June of 21, right?
That is correct.
Okay, cool. So we actually went back and got your original documentation from the insurance company dated June of 2021. And so what we're actually going to do is look at some of those values now on what's called an illustration, right? It's a document that the insurance company gives you that details for you not all of the contract language and here's what this does and here's what this doesn't do, but it actually just details for you the values. Right? And that's where it can get really, really fun. So the first thing we're going to do is we're going to jump down here to page 13 of this document where it starts talking about the values. And I gotta ask, we gotta kind of set the scene for everybody here. Back when you started in 21, you started in your very first policy, kind of toe tipping a little bit, right? Got to test the waters just a little. Didn't really understand it all the way.
Right.
Okay.
I think it's to everybody.
So I did the same thing too, right? I think I've been very transparent when I've said, hey, my first policy was actually $5,000 all year. I didn't know what I was doing. I didn't have access to a bunch of money, I thought, and so I started with what I had. Your first policy was about $3,600 a year.
Yeah,
right?
$3,600 a year, $300 a month,
and it's funny that we maybe even say numbers that are kind of lower because then you go, well, I'm working on my 5th policy, right?
Yeah.
And I go, I got some double digits here, but I didn't think I had that money way back when I started.
Yeah, but I thought that I saw it as an investment. Sure. I thought it had to be extra money that I either conjured up or made happen, or I had to skim and scrounge to come up with it. I didn't realize that all I was doing was reallocating my income and literally just being my own banker. Our money goes to the bank before we spend it, and it goes anywhere else. So all I was doing was saying, hey, instead of me taking all of my income and just putting it into the bank and then going about paying everybody else, and then I put myself last in terms of savings, why don't I put myself at the top of that list? When I get a paycheck or some revenues, take that, pay myself first into my banking system where my money can grow and produce more income, more opportunity and more growth for me in terms of the wealth that I have and what I can do with that. So I just kind of had a paradigm shift. And so that's what made me want to get more policies and put more of my income and revenue into my banking system.
I love it. So $3,600 all year, $300 a month. Where was the $300 going, kind of in your monthly budget?
Yeah, so it was either wasn't being saved at all. Honestly, it was going towards fun things. I like to at a younger age.
Okay.
My dad was with USAA because he's a veteran, and I could get rental cars at 18.
Okay.
So everybody's like, how are you doing this at 18? You got to be 25, so on and so forth. No, not me, because they didn't check anything. I had a little Hertz Gold membership. I go in there, boom. So I'm going back and forth. I'm traveling, seeing
renting cars, taking road trips.
Renting cars, seeing some ladies, and taking road and definitely taking road trips. That's
all right.
That's what I was doing. Other than that, though, is I would take the money and invest directly into the market.
Okay.
So that's a lot of what I was doing as well. And then when I understood it as a banking system and not an investment, because as an investment to me it didn't make sense. And so when I started to see it as a banking system, I reallocated my wealth to go here and then make some investments as well, which of course has that tax-free advantage to it.
Right.
So
I love that. Okay, so $300 a month. Let's take a look at this original illustration, the original values provided from the insurance company, so we can take a look at kind of where we started. So one of the two things we're going to look at today, we're going to focus on the guaranteed side of this documentation. So we're going to zoom in here on the guaranteed side, and we want to take a look at the cash value and the death benefit of this policy. Okay.
Sure.
So again, with insurance, if you don't know and you're just joining us and watching, anytime you buy an insurance policy, there is always a benefit. Always, right? It doesn't matter if you pay $100 to State Farm for car insurance or $10 a month to Apple for your phone insurance, right? There is a benefit. If X happens, the insurance company will pay. The same thing's happening here. When you make your payment, when you make your premium into the policy, the insurance company provides a benefit. So the first thing we got to talk about is your benefit. You started this policy with about $207,000 worth of benefit. And the question is, being a young gun like yourself, young buck, who's the money going to? Who are you giving the money to?
Yeah, so I don't have any children right now. Hopefully everything pans out chronologically and it goes to them. But right now I have my siblings being on there, and I also have my girlfriend on there as well, which is a little bit scary sometimes when I make them mad. But she also has me on hers. So we got a mutual risk involved.
Okay, I like mutual. All right, I like that. Very good. Now here's where it gets fun: cash value. A lot of people get confused about cash value, but let's make it super clear for her. Cash value is actually just equity of the death benefit that you could get to.
Yeah, it's just money I can take from my death benefit right now.
Right now, right? So on your screen in front of you, you can see that his first year cash value is $4,700. So let's be clear. If you were to take that $4,700, that death benefit would come down from 207 and to be sitting right around 203 and change. That makes sense, everybody? And I know that makes sense to you.
Yeah, it makes perfect sense.
Okay, cool. So $4,700 in the first year, $6,900 in the second year, $9,100 in the third year, $11,900 fourth year, $15,200 fifth year. So as you originally got this policy 2 years ago, now exactly 2 years ago, and you're seeing the numbers, what are you thinking to yourself?
Yeah, I'm thinking as they go up, I'm thinking that I know, like you said, we're going to look at the original and then the revised, more updated version. I'm thinking that these numbers are low.
Okay.
Compared to what I now know and understand about it. Being my own banker and the power of that. But I'm also looking at the fact that we didn't address the dump-in per se.
Oh, okay.
But
Let's talk about it.
I did an additional amount of money. So I had some money from investments, and I took money out of an investment, and I put it into my banking system as a one-time deposit, which increased my death benefit right off the back, and it also gave me more cash value coming into the policy that I could be utilized. So literally, I took a loan within my first 2 weeks. I think I put in a total of a little bit. It was like $3,700, and in my first 2 weeks, I took a loan for $2,500.
I love that.
And then I went and put that down towards some credit card debt, and basically just I used cash value from my policy to pay down on those credit cards, which of course alleviated some of the stress and the monkeys off your back, so to speak. And then from there, I was able to take and pay back what I was no longer paying towards those credit cards. I could take and pay that back towards my policy and keep that wealth.
See, I think a lot of people miss that, right? A lot of people don't realize that being a banker is actually just two transactions. It's taking the loans and then repaying the loans.
That's it.
And it makes it so much easier to repay loans if you actually took the loan for something useful or to clear up a debt or a bill in your household, right? Like you just mentioned, you said, hey, I took a loan right away. I paid off a credit card bill with it. So the bill, like the monthly bill that's going to Visa or whatever, you don't have it anymore. So it's right now, it's August, right? If we paid off a bill in August, guess what happens in September? Yeah, there's no bill.
Yeah, exactly.
Right?
I think that's what you should do is you should be using your cash value, the value of your life, right?
Yep.
Right now to alleviate some of the stresses in your life and keep more of your income in your pocket.
That's right. And then as soon as you do that and pay off a bill like that, well, you just freed up income. You freed up money that you earn that you used to just willingly give away. Now you earn it, and now you can absolutely go and apply that back to your policy.
Exactly.
It's easier that way. It's like, why wouldn't I do that? The same system that helped me get here is the one I'm now feeding, right? Does that make sense?
Exactly.
So here's where it gets fun. You did that for the last 2 years. It's been exactly 2 years since you started this policy. So what we need to do now is look at where you stand now. Does that make sense? It's been exactly 2 years, so not year 1, not year 2. Those are past, so we want year 3. We want to know where you stand in year 3. So we actually asked the insurance company to send us a revised packet. Send us the values again now, today's date, instead of 2 years ago, because you've been banking. So the question at hand is, do we think that they're bigger, smaller, the same?
Definitely bigger. I've been working my policies, which of course is why I went on to get more policies. So I've been doing some work, man. Let's take a look at it.
Okay, here we go. So this is what's important. We want to take a look at year number 3 instead of, and we'll go back and show, we'll compare and contrast at the same time, okay? But as you can see the cash, well, first off, let's start with that death benefit. This is important. If you remember, you started 2 years ago at $207,000.
Yeah, I have an increase of almost about $70,000. It's now sitting at $284,000.
$284,000. So again, now that we've had like a $70,000 increase, you got some room to put me on there, right?
This man really asked me to.
Oh man, I'm just joking with you guys. That is
serious.
for your family, your friends, your church, your charity, but it increases, and that's what's important.
Definitely, yeah, right? It goes up over time, and of course, if cash value comes from the death benefit, it also means that we borrow more from our death benefit over time as well.
I was about to say that. A lot of people miss that, man. Cash value has to equal death benefit. It's just equity of, right? And so if your death benefit's increasing like this, guess what's happening to the cash value?
It's going up.
It's going up, right? And as we can see here, 14.8 in year 3, 17.7 in year 4, 21.2 in year 5, 24,000, 28,000. You can just see this thing increasing and increasing and increasing.
Yeah.
So my question for you, how does that make you feel? 2 years in?
Well, for one, man, it makes me want to be healthier. Eat my green beans. I want to be able to get to the higher values, and because, like I said, it gets better. Like we're saying, it gets better over time. Cash value has to grow to equal the death benefit. The longer you live, the more cash you can spend, essentially. And so whatever's left over that you either spent and didn't pay back, or if you did pay it back, all that goes to your family tax-free when you pass away.
Or the more money you put in, the more death benefit you purchase. The faster you do banking, the more you do banking, right? The more overpayment you do when you're banking and paying back your loans, the higher the death benefit's going to shoot.
Exactly.
The death benefit
absolutely.
Shoots high, the cash
it makes me want to do more banking. I understand, okay, if my numbers have grown so far, I'm only going to need bigger and better purchases as I go forward. Things that I have to buy anyways, I need to start utilizing my policy more.
That's exactly correct. So to be clear as we can be, Robert, tell them what caused the growth. You've got growth, but what in the world caused it?
What caused the growth of my policy is really simple. I took loans from my policy, and like I was talking about before, I kind of got those monkeys off my back. I would tell anybody when I talk on the phone, you need to start with what takes money out of your pocket.
That's right.
If I could take away your house note, your car note, if I could take away the credit cards right now, you would have a completely different life. You probably wouldn't even be on the phone with me right now.
Significant amount of income probably coming in that no longer has to go out.
Think about what everything that's taken it from us is all the things we have to buy and finance plus the taxes. Well, infinite banking allows us to alleviate some of those taxes, which is a great thing. And on top of that too is we can recapture our wealth and get back the money on the things that we're already buying. That's so when I get the money back, when I pay back, the interest that I pay back, I also keep as well. and the interest on the stuff that I was already going to buy anyways. Now I probably would have paid interest to the bank or to a credit card company. I now have that interest growing my policy. So my policy grows even higher based on that interest because interest goes towards the premiums.
There you go.
Premiums buy more death benefit.
Say it again for the people in the back.
Interest interest that you pay back on your policy buys more goes into premium. It buys you a larger coverage on your life, a larger death benefit, and then from there, cash value comes from the death benefit
coverage you can just get right now.
Exactly.
So if that shoots up, so does your cash value.
Exactly.
That's super important.
We're trying to build wealth, not credibility.
That's right. So here's a question that I get asked all the time, right? We talk about cash flow. We talk about that so often and how important cash flow is. I think with cash value at your fingertips that you can get access to at any time, that cash flow is super important, right? But at the end of the day, I understand that some people have other concerns like retirement. That's a question that we get a bunch. So, Robert, my question for you is what age do you think you're retiring? Calling up. Now, I know that for us, we might define retirement as having a little bit more money than our bills, right?
Yeah.
Passive money more than your residual bills.
Realistically, of course, for me, I want that to be before 30 or right at 30.
Sure.
Now, if I'm going to go with the quote-unquote retirement, traditional age of retirement, I'll go 65.
65. Okay, so what I want to do is I'm going to look at your original contract at age 65 for you, and I will look at the revision at age 65. You only had this contract 2 years, yes?
That's correct.
You took loans and you repaid them, but only for 2 years.
That's it.
That's it. So I want to look at what happens at age 65 originally and what's going to happen for you at age 65 now and see what 2 years worth of banking did for you. Does that work?
Yeah, let's check it out.
All right, cool. So on our screen in front of us now, we've got when Robert is age 65 here. So you can see it printed on the left-hand side of the screen there, age 65. If we take a look at the cash value, it says $151,706 if you follow that line completely over. His death benefit by that moment would be up to $348,000. You see that?
Yes, sir.
Okay, so that's a significant amount of growth for your policy by the time you're age 65, yeah?
Oh, yeah.
All right, but let's take a look at what that looks like now that you have paid your loans back. You've been practicing banking. Okay, so you've got age 65 on the corner of the screen there, if you can see it. If we slide that over, hold on here a second, Robert. Does that say your death benefit is $613,000 and your cash value is $277,000?
At 65, the same 65 years.
At the I don't think you can turn 65 twice, can you?
That's what I'm saying.
All right.
Thing, right?
All right, cool.
That's
so
crazy.
hold on a second. 348 was your death benefit, but now your siblings and girlfriend, maybe by then you'll be married, right? Maybe kids.
Yeah.
Will get 613. I'm no good at math, man. I'm really not. But I think that's almost double. So close.
Yeah, I'm kind of upset I'm not my kids.
Exactly. Right? That's a lot of money to pass down if something happens to you. Not really if something happens, but when something happens.
We're all going to mature or expire, so to speak. And I'm looking at the cash value, man. That's a huge growth.
So instead of 151, we're at 277,000. If my math is correct, that's about $126,000 of difference.
Yeah, it's a huge difference, dude.
This is guaranteed now. I'll scroll up to the top of the page so you guys can see that word right at the top there. Guaranteed. We didn't make this up. This came from the company just a few hours ago, actually. We got this from them. They sent it to us. So here's what's important to me, and I want you to understand it. Over the next 60 years, before you retire, you probably have more things to buy, yeah?
Oh, yeah, definitely.
Maybe some cars. Maybe some houses.
Yeah, I got all that, man. No kids yet, so as you can imagine, I got a bunch of stuff.
We got to pay for the kids, right? The kids want to play ball and they want to do piano and
private school,
and dancing and school and all that. You got to pay for that.
Yeah.
So wouldn't it be pretty nice to have an extra $126,000 worth of guaranteed income on its way to you in that time frame?
Yeah, dude. And that's what's crazy is, like I said, we only had the policy 2 years.
2 years.
If you look at what can be accomplished between now and at a later date.
That's what I'm saying.
Exponential growth.
So let me ask you this question. Is there anything else that you know of that in 2 years' time, without getting super lucky, I want a guarantee 2
Oh,
years
no,
of
yeah,
what you're
yeah.
doing right now, and we
We,
can guarantee $126,000 worth of growth.
Yeah, definitely not. I know I'm big on cryptocurrency, and definitely not. For one, it's not guaranteed, and for it has volatility.
There's other things out there you can get growth in like that, in but a lot of it's cross your fingers and hope.
Yeah,
right?
even real estate can give you some pretty good returns like that.
agree.
But you have to. There's so many factors and
There's risk
metrics that
involved.
goes into it. Yeah, and instead of we're buying our wealth, we're not trying to build it.
That's it.
So I think that's a bigger difference is we're going with a guaranteed contract from a mutual company, and our policy is just designed for banking, which essentially means let them spend more of their death benefit while they're alive instead of waiting until they die and they can't use the money. So I mean
love
that's why I tell people all the time. That's literally all we're doing. I don't think we're doing something too special. We didn't create whole life insurance, and we definitely are not the insurance company.
Nope.
All we're doing is reconfiguring a policy so that it's life insurance instead of death insurance.
There you go.
That's
and
it.
and I got to be honest. After seeing this, you inspired me to go repay some loans, add some extra. Right.
Now, if you're gonna
That's
put
what I
me
wanna
on,
do.
I'm younger than you. That's
Anyway, man, congratulations. 2 years of your policy generated significant impact and growth for not only you, but for the future misses, the future kids, the future
Yeah.
generations. That's all that's happened. And in the last 1 year, I mean, you spent the money on paying off bills, right? So you're feeling good now. And you've created such an impact for them.
Completely different financial outlook right now, and I can control it. Like I said, I don't got people blowing my phone up at 10 o'clock in the morning. No, you gotta hit that button real quick because you already know. But yeah, it's a good feeling to have more control over your wealth and to know that you're building wealth instead of, like I said, we're trying to build wealth. We're not just trying to build credibility. So a pretty number on the screen doesn't do a lot when I really need some cash.
When you need money, right?
Yeah.
I love it, man. If you are interested in getting started with Infinite Banking, you've got to give us a call. There is a link to book a call with one of us, and actually in the description of this video. So click on it. We'd love to talk to you. If you've already got a policy and you're going, oh my gosh, I've had my policy for a year or 2 years.
Yeah.
Let me see what I did, right, with the growth. Or am I doing this right? And then give us a call as well. We want to walk you through that to make sure that you are capitalizing right now while you're home, while you're happy, while you're healthy, while you're active. Let's make a legacy. Let's leave a legacy by practicing infinite banking. So we look forward to talking with you soon. Congratulations, Robert.
Thank you. I appreciate it, man.
You're welcome. We'll see you guys next time.